Good morning and welcome to this webinar series which is being conducted by the Ungku Aziz Center. My name is Terence Gomez. I'm the acting director of the center as well as dean of the Faculty of Economics and Administration. Now let me say a few words about the Ungku Aziz Center for Development Studies. This center was established when a grant, an endowment was given by the government of Malaysia to the university to establish the Royal Professor Ungku Aziz Chair. And after the chair was created, the Ungku Aziz Center was then established to host the chair. The purpose of this chair is to promote the works also of the Royal Professor Ungku Aziz in the field of education, economic development. And as you all know, his focus has been on specifically the area of rural development and poverty, core issues to the center. The center was created to undertake interdisciplinary research, and the focus is really on the discipline of development studies, because it's that discipline that promotes the kind of research that we are trying to get going here, involving academics from different areas of expertise. So what we're going to do today is, this webinar series is, we're going to provide this as a platform for the Ungku Aziz Research Grant recipients. We have given out a number of research grants. The recipients have now been called upon to provide their feedback on the research that you have done. As you can see here in the slides before you, we have 10 major pillars in terms of the areas that we're going to focus on, or we have been focusing on at the UAC. Today's focus will be on Pillar 2, Poverty and Sustainable Development. Now, the theme of today's topic will be based on specifically the area of banking. We are looking at issues related to growth, poverty eradication, and how does the financial sector fit into all this. I'd like to go on now to introduce the speaker. The speaker that we have for today is Dr. B.M. Hasanul, Banna. You can see here the profile of Dr. Banna before you. But just let me say a few words about Dr. Banna. Dr. Banna has been a research fellow for a few years now at the Ungku Aziz Center. He earned his degree in economics with a major in finance at the International Islamic University. His focus today, and I'd like to go on to this, the next topic. Can we go on to this? The focus today is this, building on his area of expertise, which is on finance. His focus will be, as you can see today, the impact of digital financial inclusion on Asean banking stability, the implications of the post-COVID crisis. This is a very important topic, the impact of digitalization in the financial sector, specifically also as a means as to how to deal with the COVID crisis. Now, is DFI, digital financial inclusion, a mechanism that will help us which will help serve as one mechanism to transfer funds and support to industries and to people? This will be the topic of this discussion today. What Dr. Banna will do is he will focus on the rise of DFI, digital finance, before the crisis, focusing on a number of countries, with 4 ASEAN countries in particular, and with a focus on 213 banks. So this is quite a well-conducted study. He's got a lot of empirical data, and the period that he's looking at is over about 8-9 year period. And as you can see, this covers a period before and after the crisis. So what I will do today is this. I will give Dr. Banna about 35 minutes to speak on this topic. And after he has spoken, I will serve as discussant. And I will give some feedback, my thoughts on his research. And after I give my thoughts, I will ask Dr. Banna to respond to the queries that I've raised. And soon after that, we'll move on to the Q&A, when you can then come in and pose whatever questions you may have for Dr. Banna. So with that, let me now move on to the issue at hand. the seminar. Let's now begin. Dr. Banna, the floor is yours.
Thank you, Prof, for giving a bit introduction, and also thank you, Ungku Aziz Center, for inviting me to talk about the important issue which especially the world is facing now, the COVID-19 pandemic. So basically, the topic today is the impact of digital financial inclusion on ASEAN banking stability, and what are the implications for the post-COVID-19 era. So these are the outlines what I will discuss today. So why you should care about this study, and what is the digital financial inclusion, what are the prospects of digital financial inclusion, and what are the link between digital financial inclusion and the banking sector, and how my study will contribute to the literature, and what are the data and methods I used, and the results and analysis, and finally the conclusion and the policy recommendation. Okay, so why we should care about this study? As we know, that in a country, the stability of the banking industry is becoming very questionable, especially during this pandemic. And if it's questionable, then the country's overall economic condition is thought to be close, because the banking stability is a must for the sustainable economic growth. And financial stability or sustainability is one of the goals of SDGs, as we know, where every individual is expected to enjoy better and quality living without feeling the fear of any threat, conspiracy, conflict, and war as well. So in order to achieve the SDGs by 2030, sustainable economic growth is a must, as we know that there is a huge investment gap, is 2.5 trillion to get that achievement. So it can be minimized through the banking sector along with other financial institutions. And in order to get that, we also need to bank the unbanked people, especially the underprivileged people. But you can see here, as a matter of great regret, that still a sizable number of adults are unbanked. You can see it's 1.7 billion total number of people who don't have even an account. And according to KPMG, 73% adult without a bank account among the ASEAN country is, if we turn it into a number, it will be around 438 million individuals. So it's mostly they relied on the cash based rather than the digital one. So as we know, the pandemic is going on, and it has an the movements, social distancing, quarantine, and its abrupt closure of all types of financial and non-financial institution and activities. And it also affecting on the global financial sector, because we don't know, we cannot predict how it will go, how long it's gonna go. And previous, as we know, the effect, the previous global financial crisis was devastated. Also predicting, even economists also predicting this will be worse previous one. However, there are some, due to the COVID-19, there's some restriction on the lifestyle of mankind. That's why, the economic growth gets hindered, getting high unemployment. It started in China, but the later on it's affecting Europe, Africa, America, Latin America, and ASEAN as well. And initially, IMF at the beginning of this year, they are predicting that 82% of the country's GDP will rise, but that due to the COVID-19, the prediction has failed, and they again predicted that the overall GDP of the world will decline by 3%, which we can already see in Q1 and Q2 is a negative growth. So it could be the biggest test of the post-crisis financial system to date, and this is because of the uncertain magnitude and the duration of the recession. And since we human being cannot be deported from the financial affairs, so they somehow directly or indirectly related to the financial affairs. So by any means, the financial affair to carry out the financial affairs, through the banking system, the banks need to carry out their operation by any means. And there are some, the stimulus packages is introduced by the government to help the people, which are also disbursed through the banking channel. So it's a great pressure on the global banking system. As the outbreak continues, banks see the COVID embraces, and it's very tough for the banks to retain their stability. And scholars already think that DFI, the digital financial inclusion, could be a possible solution to retain the bank stability based on the previous experience, which was basically the financial inclusion one. And you can see the one of the largest financial in a company based in Spain, the head of the digital regulation, Pablo Orbiola, already said a few months earlier, the experience of the last few months leaves us with a lot of useful lessons that can be used to map out the future of Europe's digital finance strategy. So basically it's showing that how important the DFI and how it works to maintain the financial stability, especially the banking stability. So basically what is DFI? It's a digital access to and the use of formal financial services by the excluded and unserved population. So it's an advanced and the technology based financial inclusion, which is also called digital financial inclusion. We need the innovative financial product and financial related software that can, the interactive way, like it's a gateway of interaction, communication with the customer and the fintech or other financial related institutions. So it's also the transfer from cash based to cashless, and you see the Bill and Melinda Gates already predicted that by 2030, 2 billion people who don't have bank account today will be storing money and making payment through their phones or any digital innovative technology based financial system. Okay, so what are the prospects of DFI or digital financial? So we can see the adoption of digital finance will have a significant impact not only on financial inclusion but also on inclusive economic growth. And McKinsey Global Institute predicted in 2016 that 6% GDP will grow and which will alleviate poverty, and that will basically through the inclusive economic growth. And as the GDP is seen as the key index of the development of a country. And there's another study by Clapper. He said that there is a prospect that's the transformation of informal business to the formal business using the digital finance. So it will help to collect more taxes, which are not collected. Those who are, you can see the street hawkers and all the other businesses which are tax uses are not really taxable now. So there will be more tax collection, which will contribute to the national revenue sectors and eventually makes the country's economic growth stable. All right, so you can see the infograph here. The newly job created deposit will increase, the annual government leakage will increase. So there will be some transparency among the, lot of activities. And there will also a new credit and new job 95 million by 2050. So what are the constraints to financial inclusion, or we can say is a digital financial inclusion? So basically is the constant from the both side, the demand side and the supply side. Demand side is basically from the client perspective, and supply is those who are giving these services. So the main barrier is basically the volatile and small incomes, geographical barriers, informality and lack of documentation, and of course the literacy and the trust. And from the supply side is a high cost operating services, legacy business models, and limited competition and innovation. So what are the benefits of digital financial services? It's cost effective and speedy, transparency, security, and more convenience. So there are some other, the binding constant to promote digital financial services. It says conducive legal and regulatory frameworks. This is one of the main issues, the supervisory and the regulatory issues. And there are some other issues like enabling financial and the digital infrastructure. It needs some setup, so it will be used. kind of initial costing, and also the government support system. So these are basically the constraint to the financial access. And we can see there's some differences between the traditional model and the digital solution, which is a fintech, or maybe we can say the digital financial inclusion. So in case of payment system, there's just some gap. You need the cashiers, ATM, and checks. So it takes some time to give the payment and the settlement. So there is a gap in speed. And for the savings, there's a costing gap, and for the borrowing perspective, there's a transparency between the two parties, and managing risk, there's excess risk, and get advices like the security issues. So pre-traditional model, they have some gaps, where you can see that in the digital solution, we can mobile POS, P2P, virtual currencies, or maybe the blockchains, mobile market funds, and crowdfunding. There's a borrowing, credit modeling, auto underwriting, and there's some race tech. That is a eKYC, is electronic know your customers, and the digital ID, and also the robo advising system. So this is basically the difference between the traditional model and the digital model. So these are the development stages of the digital financial inclusion. We can see from the dominant cash based to the fully digitalized. So it's a 4 stage. We can see it's a industrial revolution 4. So it's a changes from basic access transaction to more intensive use of transaction amount accounts for the digital payments. Then moving beyond that, like credit and insurance. And of course, some countries, they are widespreading adopting usage of digital financial services by individuals and the SMEs as well. Okay, so what's the link between DFI and the banking sector? So the wider inclusion can help bank attain stability, push for financial advancement, and increase bank revenue by reducing costs, and advances the global financial sector. And DFI is more faster, efficient, and time-saving and cheaper. Many countries are already started practicing full swing to retain their financial and banking sector stability. Even, of course, the ASEAN is not the exceptional. It also started do, and the trend of opening, you can see an example, the trend of opening bank account in ASEAN countries through online platform recently has very visibly increased. And DFI has the potential to lower cost by maximizing the economic scale, to increase the speed, security, and transparency of the transaction cost, and to allow for more tailored financial services that serve the poor. So there are some other constraints as well for the DFI, excessive financial innovation that might affect the financial stability. That means it may create some instability if there is no proper regulation and supervisory activities by the regulatory authority. And there are some predatory lending practices which already seen in Indonesia. That's why Indonesia already banned 1,000 illegal P2P lending agents. And there are some data privacy issues, cyber attacking, money laundering, financing terrorism, and of course the scene cloning and the mobile hijacking. However, both this negative and positive effect also questioning whether is it a good solution or the full-fledged implementation in DFI in ASEAN banking sector, especially the post-pandemic period, can be a solution for attaining the banking stability or not. So this study aims to empirically examine the relationship between digital financial inclusion and the banking stability in ASEAN countries. So before that, let's look at the what are the financial stability. Before this, we can say is somehow is contribute to the literature in the digital financial inclusion and the banking stability as well. The data we already we took the 4 ASEAN countries. Is Indonesia, Malaysia, Philippines, and Thailand. We couldn't take other countries due to the unavailability of data of the digital finance inclusion indexing. And this, the including Singapore, these 4, 80% of total ASEAN banking industry asset holder. And we took, like initially was selected we choose 256 commercial bank, then we have to filter out, and finally we choose 253 banks over the period of 2011 to 2019. And most proportion of the Indonesia has the highest banking, is 45 in our simple, then followed by the Philippines, Malaysia, and Thailand. So we use some of the sources, especially for bank data for the Orbis Bank Focus, then Financial Service Access survey, which is basically given by the International Monetary Fund, and the Global Findex databases. And also we use the WDI World Bank database for macroeconomic factor, and also some other literatures for the instrumental variables. So these are the mainly the main methods. The banking stability we measure using the Z-score, and also we took the volatility. We also control bank size, loan ratio, loan performing, loan loss ratio, revenue diversification, management quality, capitalization, concentration, specialization, GDP inflation, and also the good governance. We use OLS and the panel character standard error for the robustness test, 2SLS, two-stage least square instrumental variable, as well as ZMM for the endogeneity. So financial inclusion index, we have decided into two sides, that both supply side and the demand side. You can see money agent, money is geographical as well as the demographic penetration, and also the mobile money accounts, the transaction, the volume of transaction. We also use some alternative proxies as well. So using the PCA, we created the index. So before going through the whether we have an interaction effect with this, the banking stability, is synergies or trade-off between the banking stability and the DFI. So let's look at the banking stability among the countries over the period of 2012 to 2019. We can see it's quite good for the Malaysian banking sector. Is improved upward trend. You can see the red color here, and mostly we can see the Philippines is more volatile. It's like in 2000 and in recent year is declining trend, and some other two countries is also the volatile, but I mean more the Malaysian bank is more stable as compared to others. And let's look at the what we found in the digital financial inclusion index. If you look at here, it's increasing trend almost all countries. If you compare with 2012 to 2019, it's definitely improving. And DFI is basically the overall financial digital financial inclusion, where SA stands for the is a supply side, is access to digital finance, and D is the demand side, is a usage to digital finance. So we can see that Malaysia is in terms of the usage, Malaysia is number one. And if you see the overall indexes and the access to the digital finances, Thailand is quite improving, and they are outperformed than others. Okay, so these are the overall index. You can see here, that's already mentioned here, our previous slides. So these are the main results. We can see this, though it's an early stage of digital finance, still we found some positive relationship with the banking stability. That means it's a significant, and if we look at the risk taking, it's a negative relation with the risk taking. So it's a better. I mean, if it's improving the digital financial inclusion, there will be less risk taking in the banking sectors. That means it's more stable. So when the digital financial is enhanced in a country, the volatility is less, hence the more stability is obtained. So we see here the usage and the overall digital financial inclusion is quite significant, whereas somehow the excess is not significant for this region. It could be some of the lack of access to the digital finance, as bank did not provide sufficient mobile banking facilities and or the Asean outlet service, especially in the remote area of these regions. Hence, they are unable to open an account, but those who have access, they can utilize this service properly. And this is, we can compare between the Islamic and the conventional one. We can see that conventional are bank are more, the more sensitive than the Islamic bank, and it's a you can see the significant relationship has been found for the commercial, that means the conventional bank, and this and then the Islamic bank. So this is similar with the previous studies, though they use like the other country as well as only the financial inclusion in general. So it's inclusive digital financial inclusion is inclined to boost banking stability. That's a greater implementation of DFI is moderate the excessive risk taking trip of a particular bank. So it's as we already mentioned that it's a conventional bank are better position as compared to, maybe this could be the Islamic bank are in very early stage and they are not fully taking the advantage of DFIs. So let's look at the conclusion and what are the policies we can get it. So from the study, we found that the proper implementation of digital financial inclusion has been, though is a global leaders is already, that is thinking about this is quite long, but the COVID pandemic has put forward question on how digital financial inclusion can be a feasible solution to react the crisis and how the crisis in turn would accelerate digital financial inclusion. So we have some positive relation between the banking stability, and so that means digital finance are reachable, as the digital finance are reachable through the mobile phones or the computers or any other electronic devices that can reduce the face-to-face reduce the face-to-face contact, and also the keep connected to the financial transaction and activities even in the face of the crisis like this COVID pandemic. And the government, standard setters and policymakers should implement a digital financial service at a rapid pace in a full phase. And in that case, they need to bank the unbanked people and to minimize the liquidity risk. And it would be one of the things that might affecting the banking sector, especially during this crisis, the liquidity issue. So they can increase their deposit from the clients, and also it will minimize the operational cost, and it will increase the money circulation even in the mobility restriction. And digital financial inclusion is an instrument that can help financial and the monetary system regulators to reduce the level of inflation in both poor and developed countries by restricting the circulation amount of the physical cash. And besides, we can say DFI plays a significant role in enhancing the welfare of individuals and business sectors, through which individuals can easily access funds in their banks to perform financial transactions. During any pandemic such as COVID-19, DFI can help government to reach out to those in the informal sector and those who do not have access to the formal banking account to provide the emergency responses. Since we have found some DFI access is insignificant or low score, so policymakers should ask the banking sector in this region to expand their agent networks and other access points and improve the design of their existing products by implementing artificial intelligence or the machine learning to fascinate people, all economic classes. And banks should introduce services how these people can open an account sitting in their house through the electronic devices. Though some of the countries, they already started this, as the COVID-19 crisis makes them reluctant to go to the bank branches or agent outlet physically to open an account. And also we have some low scores in the uses. So people, especially the middle-aged or aged people, should be provided with proper digital financial literacy. And maybe we have to need to find an alternative way of using how they can use, and they can ask them to use the digital platform to do their the financial activities. Government can provide subsidies to those who are in need of cash to buy smartphone or to use internet facilities. People's trust level need to increase. For example, they can insured amount might be increased. The regulatory body should assure that the electronic devices of the clients have uninterrupted internet connection and are supported with the latest technology. And we can see the bank in the sample to prevent the card cloning and should upgrade their databases and launch the money withdraw through scanning the QR, maybe the NFC system they can implement by the mobile phone, which are already prevalent in the countries like Singapore, Turkey, Spain, and so on. All right, thank you very much for listening my presentation.
Okay, thank you, Dr. Banna. Please keep the slides on because I will be referring to the slides. Let me first say, Dr. Banna, that this is a very impressive study, and I was quite taken up with the volume of data that you have. You've looked at about 210 banks in your research, but I'd like to now go on. While you provided a very macro picture, I want to break down the data that you have and look at some of the more conceptual issues that you talk about in your study, but have not been elaborated on here. First, I would like to bring in the concept of ownership and control. You have 210 banks from 4 countries. How many of these banks are state-owned banks? And how many are commercial banks, privately owned banks? I want to make this distinction between banks that are owned by the government and banks that are owned privately, because that does make a difference in terms of volume of risk-taking also. Second, among the privately owned banks that you looked at, how many are foreign-owned banks and how many are local banks, domestically owned banks? I think these distinctions are important. If you want to talk about digital financial inclusion, it matters who owns the bank. So I couldn't tell from looking at your 210 banks, how many of these banks, as I said, are state-owned, how many are foreign-owned, how many are privately owned. I'd also like to point out that you suggested also another distinction, but didn't get into it too much. It's an important distinction. Islamic banks versus the more secular banks. There's also another distinction here. Some of these Islamic banks may be state-owned banks. Some of the Islamic banks are privately owned. Some of them may be foreign-owned, Paul, you know. So again, important distinctions. I do think that these distinctions are important. And these distinctions are important because it then gives us greater insights who are the more risk-taking type banks. Is it really true that the SOE banks don't take that many risks, while the privately owned banks do take risk? Does your data suggest that? I don't think so. In fact, if you look at some of the slides that you have, I can't remember now which page. If you look at some of the slides that you have, okay, sorry, go up, please, here, stop here. If you look at some of the slides here, countries with a lot of state-owned banks, for example, China and Vietnam, in terms of population size and in terms of percentage of banking services as opposed to the population, China and Vietnam look quite good. Brazil also, a lot of state-owned enterprises also looks quite good. And then you compare it with Philippines, privately owned, and it may not, and even India has a lot of privately owned banks. Not so good, I would think. So my impression, it's only an impression because you have to tell me, you did the study, not me. You have to tell us, does it make a difference who owns the banks in terms of the DFI that we are talking about here? Now, the second point, that's my first point, ownership and control. My second point, which I would like you to develop on, how will DFI lead to inclusive growth when poor people have no access to banking facilities? You yourself said the volume of poor people who have access to banks are very, very low, and you want to increase that. But here's the reality. The reality is private banks are very reluctant to go to rural areas. Most banks I know, especially the big banks, the foreign banks, and will be very reluctant to create branches in rural areas where normally you would see a lot of poor people. Secondly, and this is a fact, banks also are very reluctant to provide facilities to the poor. That is a fact. So here you're talking about DFI and inclusive growth through banks who may not be interested in the target group that you're looking at, actually the poor. So I'm a bit concerned with those issues that you have raised. The third point, and this flows from here, access. Can we go to page 28, please? Now, I'd like to come to this. You didn't show this much, but in fact, I found this a fascinating diagram. If you look at Malaysia, DFI usage very high, but access very low.
Sure.
That's an anomaly to me, and how is it the usage is so high, but the access is so low? Who actually is using then this DFI? And I would think this is middle class, urban middle class. I may be mistaken. Then look at Thailand. Thailand is very interesting. DFI volume low, usage low, but access very high. I can't make sense of this, and I'd like you to tell us how do we interpret this when you compare Thailand and Malaysia. And then look at Philippines. Philippines is very, very interesting. DFI usage very low, access high. Again, how do we, there seems to be something missing. I am finding difficulty interpreting this. And then Indonesia, DFI usage higher than access. And there are variations here. There are variations here which are significant. I'd like to point out that Malaysia has a lot of state-owned banks. We call them GLC banks, a lot of GLC banks. We also have what is known as development financial institutions, DFIs, also banks, Agro Bank, Exim Bank, SME Bank. Do they figure here in your data when you talk about this? Does this explain the issue of usage as opposed to access? If Malaysia has DFIs like Agro Bank, SME Bank, which is supposed to target the poor, why is DFI access so low? I'm just looking at Malaysia because we know Malaysia very well. So we need to interpret this a bit more deeply. I also want to make one more point. And you said this in one of your slides. The slides indicate that countries with high tech, with very high technology like China, United States, Sweden are also the best in terms of using DFI. Can we come down, please, and see whether we can see that slide? You would probably know which slide I'm talking about. Comparing different countries. I would like to show this slide to the audience.
Oh, okay.
Where we talk.
Is it the?
Yeah, here it is. Now look at this. China, USA, Sweden. The first thing we notice is these are countries with very high technological capacity. And then you compare them with stage one. Look at these countries in stage one, all very low in terms of technological capacity within the country. The volume of high technology in these countries is very, very low. And that explains a lot as to why China, USA, and Sweden are very high. It also explains why they're able to have DFIs. So what this means here, if you compare stage one and stage four, and Malaysia will be probably in stage two, if I'm not mistaken. Correct me if I'm wrong. Malaysia will probably in stage two, while you put Vietnam in stage one. But Vietnam is doing very well, according to your figures, although only in stage one. Now, Brazil seems to be doing better than Vietnam. But here's the point. Let's leave this aside. Here's the point. If DFI is to work, the volume of high technology employment in the country must be high. It must also be high in rural areas. We know in Malaysia, for example, the volume of use of high tech in rural areas, the infrastructure is very, very poor. In education, you can see children having very poor access to education because they don't have high-tech infrastructure in rural areas. What more when it comes to banking? So how then do we talk about access when the infrastructure is so low? This brings me then to the point which I want to close on. Your focus of your paper is bank stability. I would like to suggest what you should really focus is on the issue of region, location, and class. Location matters. When we look at urban areas, of course, this is not a problem. When we go to rural areas, this becomes a big problem. And then the second issue, the issue of class, region and class. Class is important. Poor people, even in urban areas, don't have access to banking. Class is also important. Poor people in rural areas have a double whammy because they are poor and they are also out there, and the banks don't want to go there. So this raises an important point about region and class, which I think needs to be brought in if you want to talk, because you want to talk about inclusiveness, you want to link this to the SDPs and so on. You want to talk about poverty eradication, which is what you say in the beginning, but I don't see the connect between DFIs, digital financial institutions, and banks servicing the people, poor people in rural areas. Second, I also want to mention this point. In Malaysia, we had what is known as the bank consolidation exercise. I don't know what it's like in other countries. From what I do know, many countries have regional banks. Many countries have small banks in rural areas too. It's a different kind of banks as opposed to the large-scale banks, the foreign banks, the SOE type banks. Malaysia doesn't have regional banks after the bank consolidation exercise. The bank consolidation exercise meant that Malaysia, which had about 57 banks and banks in various states, all were consolidated to create anchor banks or big banks. So now we have about 8 or 9 big banks. These big banks now, I do think, don't want to service rural areas. So this also matters, the type of banks. Do we have regional banks as opposed to large banks? And surely regional banks would be very important if you want to talk about DFIs. Did Malaysia do a disservice by closing down all the regional banks? So now we have big banks with not many small banks, if you like. While small banks also did a service, and small banks are better served for this kind of issues that we are talking about as opposed to the big banks. So I'd like to end on this note. I've raised 4 points, which I hope you will take us through and give us insights into, because I do want to end with this point. I do think DFI can be a mechanism to be more inclusive. However, the structural features of the countries that we are talking about don't allow for it. And we have to solve the structural problems first before we can talk more about the use of DFIs as a mechanism to reach out to the poor and to eradicate poverty. Okay, Dr. Banna?
Yeah, thank you, Prof, for raising the very important questions. So basically, for the ownership structure, though we did not exactly, say there how many banks in foreign owned and how many banks in state owned, how many banks in the private owned. So basically, we just run a few regression among the state owned and the private owned, and also the foreign owned bank. So initially, we found that the private owned bank and the foreign owned bank are more sensitive in the DFI and the bank stability nexus. So whereas the state-owned bank, some of the countries, they are not much, the effective in that country. Especially utilizing the proper digital financial inclusion, and some of the, and especially another point I can mention you that when you compare between the big bank and the small banks, the small bank relationship is not significant, while the medium and the small bank has highly sensitive with this relationship. That means the small bank and the medium bank, they are more the advanced. They are more they are using they are using the digital finance and all those mechanisms, like the advanced technologies to attract their customers, especially, and also they are trying to the microfinance style operation to go to the poor and the underprivileged people, those who are not banked. So those who are still unbanked, so they are trying to capture those unbanked people to bank in. For some, you said there are some banks, is a regional bank and other types of ownership structures. So basically, we haven't compared due to the unavailability of the the ownership structure data. So we are just compared between the foreign-owned, state-owned, and the private-owned. So we got that the especially the private-owned bank and the foreign-owned bank, they are outperform the state-owned bank in that case. And second issue.
So foreign banks outperform the private banks.
Yeah, no. Foreign bank and the private-owned bank.
Outperform the state-owned banks. Okay.
But we haven't, I mean, the run like country by country. Maybe if we run the country by country, there will be some different scenario.
Yes, that's right. Each country matters.
Each country matters.
It does make a difference in each country.
Yeah, that's true.
Because you're making a generalization here across the board. Well,
that's true.
It may make a difference in go from country to country.
And okay, so the second point you mentioned about
this figure.
Yes. Yeah, this figure. We can see here the excess means how many agent, I mean the banking agent or maybe the mobile agent, some other or the POS, point of sales, they are providing the banking sector or other fintech company, they are providing their services for the agent network for the customers. So you can see here the Thailand, they have huge, I mean, if you know that if every shop, you will find some of the their mobile banking facilities, mobile money transferring facilities, and point of sale services, because there's Thailand is quite a huge area, and that's why you see in terms of if you compare with the other country is high, especially during the excess. So in terms of the agent network or mobile networking, how the banking sector and the other financial institution or the fintech, they are providing the facilities for the customer. So it's quite high, even in the Philippines as well. Whereas in Malaysia, you can see, especially some other rural area, you cannot see much as compared the developing countries. If you look at the other Thailand and even in Indonesia, we have some we found some of the excess there, though they have some I mean, is compared to the Thailand and Philippines, they are low, but in Malaysia the overall DFI is quite okay. I mean, it's high in terms of, although Thailand is the second highest. Is due to the uses, because it's we combine this uses and access to get the full overall digital financial inclusion. So the uses, you can see those who have access, they are fully utilizing these services in Malaysia especially, and Thailand, they I mean the mobile banking sector or the financial fintech sector, they are also providing and already provide some of the facilities, especially the agent banking, agent networking, point of sale service to the customer. That's why it's quite higher than the other countries.
Does that mean that for other countries, the middle class, for example, don't really fully utilize the digital financing?
It could be, but recently, okay, just for the extension of this study, I also run, as you asked the last question about how we compare with the poor and the rich people, and also the rural and the urban area, right? So basically, we run a regression. We have data in the Findex, global Findex is provided by the World Bank. We can get some digital finance, so how their digital payment data made or received the digital, I mean, they receive something through the digital way of digital activities like the digital payment. So we have run this regression, and we found that the women, especially women, are more sensitive as compared to men. And we can see in this region, especially the East Asia Pacific and the ASEAN countries, and the women are better performing than the men.
So women use it more than
yes men. In this
so
region.
There's a gender perspective.
Yes, and also those who are the undereducated and the educated. So those are primary educated, especially some countries, not the all. Especially in Thailand, those who are undereducated, they are using more than the educated person. And also,
how do you explain that difference?
So we just run a regression this one and find the sensitivity analysis. So we can see the undereducated relationship is, the coefficient is higher than the educated one. And also we see the rural and urban. The urban area is more, the sensitive than the rural area.
Sensitive to what?
Sensitive to the relationship, the digital finance and the banking stability. So that means those who are living in urban, they are morely utilizing these digital financial sectors. The technology-based services they are using more than the rural areas people.
I'm still trying to understand Thailand, because Thailand is an outlier. They are very good in terms of DFI use
access. Yeah.
The DFI access is, yes, very good in DFI access. They are very good in terms of the facilities, but they are very poor in terms, to my mind, in terms of usage. So how do you explain that? And Thailand is interesting because Thailand does not have SOE banks. Thailand's banks they have a lot of huge banks,
True.
Which are also privately owned banks. You don't see state-owned banks, and you see foreign banks. But because they also have a lot of privately owned banks, I would have thought the usage would be higher, because the suggestion is privately owned banks tend to be more, you said it, they tend to go out more and try to use these facilities a lot more. But the usage is not there. So how do you explain that, Banna?
I think this digital financial inclusion is basically the overall country's the indexing is not only relate only the banking sector but also the other fintech institution as well, because you can see my here is the way I created proxies is basically they see the demand side and the supply side. So we can see is a supply side is basically excess. Excess means that they have more agent outlets in Thailand, and also in terms of the demographic and the geographic penetration. Like those who have, those who are providing this service, they have provided enough agent in their area. To attract the people. That's why they are not using much, but they are providing a lot of agent outlets so that they can attract the people, they can use this properly, and that their usage can be expanded. That's why they are providing this. So still the people are not using. Maybe there are some, the issues we can say is that they have lack of digital literacy. Could be one of the reason they are not using the things.
So let's move on, because I would like to bring the audience in.
Yeah. I think.
So you have answered all my questions. Yeah. Okay. So let me now, I open this up to the audience. Can we see the questions now, please, from the audience? On the issue of, I just want to close on this while I'm waiting for this to come up. The issue between region and class, don't you think those are important variables that we need to pay a lot of attention to?
Yeah, I think it's very important, and I'll look at it.
Okay, so let me now go on to, we have a question now from Devi Yulianti from University of Lampung in Sumatra. Thank you, Devi, for joining us at this forum. Her question is this: how do we service and facilitate the rural community with digital finance services? Again, it comes back to that. How do you get the banks to get into the rural areas? Now, Devi correctly says people in rural areas are lacking in financial literacy too. Again, another problem, education. there must be a special banking institution which has specific objectives, which is to reach out to this community. So how do you respond to that?
I'm completely agree with Davy. So yeah, we need some special banking institution, especially maybe the bank, central bank can help in this regards. Like they can, find some. I mean, they can introduce some of the sector. Those I believe they have the financial literacy sector. They can arrange some seminars on some symposiums, and how especially is relevant to the poor people, so they can understand how we can use these things and what are the benefits if they use this. So we have to provide this message to them and ask them and provide the facilities how, and provide them all the information how they can use it properly.
I would like to build on the point that Devi made. The role of the government here is very important.
Yeah, of course, it's important.
So it's for the government to create the infrastructure. It's for the government to ensure that these poor people do get access to it. But the services, however, are provided by the private sector. And the private sector may not be willing to do this service because there's no profit. The profit margins are very low. True. So I'd like to come back to this point because I think Devi raised a very important point.
Yeah, that's true.
I mean, Devi's point is the same point that I was trying to suggest to you. It's a regional and class issue. The focus of this talk today is supposed to be on how do we help reduce poverty and bring the poor into the financial system, which is very important so that they have access to money. But that doesn't seem to be happening. So how do you reconcile this? The government needs to intervene with the private sector, however, not willing to, even if they create the infrastructure, not willing to go in and provide the service.
I think sometimes it needs the government intervention for the sake of the overall country's development sometimes.
Which is why I like to come back to my point. If you have state-owned banks, the government can direct the state-owned banks to go to these areas, even though they may not make profits.
Yeah, that's true.
Because the state-owned banks are not so interested in profits. They are more interested in the social dimensions, such as eradicating poverty and providing access to financing to the poor in rural areas. Do you feel that you saw a lot of this in your research?
The thing I found here, yeah, you are right. If the government-owned bank can help in this regard, is really good, and government can directly intervene them to go this side and provide the service to the poor. Whereas it's very difficult to pressure on the private sector or private-owned bank. But the good thing is the private sector banks are now is coming out. This moving forward to help the poor as well. You can see in my recent study I found in some other region, especially in the sub-Saharan Africa and also the South Asia. There also the private-owned bank. They are moving forward to help the people from that there are some, they have like CSC, right? So corporate social CSR. In the form of corporate social responsibility, they are providing these services to the poor people and the underprivileged one. So I think this we can see if the government and the private and all sector can work together, then they can, there will be solution for that.
Okay, but is that happening, Banna? Do we see that kind of cooperation between the public and private, the government working with the private sector to provide this kind of services? Because these are risky and also access, I mean, to create that access is also expensive.
Yeah, that's true. Though it's an early stage, so it's very difficult to say whether it's happening or not. But let's see. Hopefully, they will sort out some the issues and find a possible solution for that.
Okay, I'd like to thank Devi. Devi, that was a very important question, and I do encourage members of the audience who have tuned in, please do post your questions. I'd like to get Banna to provide more insights into his research. So let me go on to the next question, which is also again interesting. this is what the question reads. When you, Dr. Banna, mentioned about foreign and state-owned banks, how do you determine ownership? How do you know which is foreign and which is state-owned?
So we basically follow the the bank scope definition of the its ownership is 51% owned by the I mean if it's foreigner then it's called it the foreign ownership.
So the equity ownership figure 51%
Yeah,
is the 51% and above, then we know who the ultimate foreign owner is. Does that make a difference, as I said, SOE and foreign? Because these are two powerful institutions. Domestic banks, I like to leave them to one side because they tend to be smaller. We have the small regional banks as opposed to the large banks too. But they also have very limited resources. But when we come to foreign banks and when we talk about state-owned banks, they have far larger volume of resources. They have far greater capacity to do this digital financing than the domestic banks. So did you find a big difference between those two, between state-owned enterprises and foreign banks? Did you see much differences between those two powerful institutions, also in terms of competition and in terms of providing these services? Digital financing services.
Yeah, so not really. I couldn't find enough difference between them, but yeah, so it's less sensitive as I found from the data. Is state-owned bank is less sensitive than other.
So thank you for that question. I do think, and I endorse the second question too, I do think the ownership patterns do matter.
Yeah.
In fact, I think the ownership patterns really are the key factor in terms of how we can promote digital financing, especially as a mechanism to resolve poverty. So let me go on now to the third question. In your opinion, how do you reconcile the need for more regulation? Very good point. Regulation of digital finance with the rise of corruption scams in Malaysia, for example. This is a very good point. Many people are scared of digital financing, digital use of the banking sector because of the numerous scams that we are seeing. Now, won't this make implementation of digital finance also slow, in spite of the urgent call for digital inclusion? Very good points. I'm very glad these points have been raised. How do we promote digital inclusion when people are scared of using digitalized banking because of hacking, and as the Aizad has said in his question, the possibility of corruption?
Slowdown, yeah. So yeah, it's a really very good question. That's why initially I raised this question as well. That's the proper, it's a lack of proper regulation and supervision, and also the proper regulatory body as well for the is lackings in the present the digital finance system, especially some of the countries, the developing countries. So what it can, yeah, it's making some slows down, like there's some raise tech, it's a regulation technology there.
Yeah,
it's important, so they need to implement this raise tech as well, and also the proper digital IDs, so that and EKYC, it's electronics know your customers. These all are very important to I mean to handle these issues especially, and of course the updated, and it's very difficult to update the every software. There are some hackers, and in all over the world is even the more secure banks, they're also being hacked by the hackers, but it's quite difficult. Yeah, but there should be some kind of the should find out some solution. But if it's possible, if we have the unbiased regulatory bodies and the supervisor, and they also implement the raise tech regulatory technology, then that there is a possibility that it can minimize the risk.
So you don't think that huge increase in number of scamming that's going on is going to be a major impediment to the promotion of DFI?
Yeah,
It will be.
definitely, yes.
So how do we overcome it? That's the key point. Question.
That's why you need to, the proper regulatory bodies to handle all these things. So you have to be very, very prompt on this.
But
So you have to think how the hacker is thinking is beyond that. Otherwise, it's very difficult to the handle, and especially you have to raise some awareness to the people. Even you see, recently I saw on news is a scam on one teacher. He has been scammed by some African guys or something. But you see, they are very educated person, but how they are, they scammed by this false information and all those things. So they have to think about more deeply, and before doing any transaction, they need to verify these things in some other sources. So there should be some verification process, and it should be very I mean, this should be prompt. I mean, establish the regulatory authorities should establish some of the department who will handle this cyber attacking and all those things.
I see. Okay. I'd like to go on to the next question by Li Xiaoping from University of Malaya. Will the risk brought about by digital financialization to credit be a bigger problem? Again, I feel this is an important point. If you look at the global financial crisis, the volume of credit given to people who were not creditworthy in the end turned out to be quite a serious problem. So here we are promoting digital financialization. We are promoting the idea of providing credit, but may this, looking at history and what history has told us, actually lead to a larger problem? While trying to solve one problem, we create another problem. What's your take on this, Dr. Banna?
It's a very good question. So I have found some of the studies, those who are working on the financial inclusion with the banking stability, they found two types of the findings. One is they found, okay, the digital or financial inclusion is good for banking stability, and another one where that is not good for the stability, rather than is destabilize or instabilize the banking sector, especially if there is a lack of supervision and the regulatory regulation. So these two are very important when we implement this digital financial inclusion. So if the supervision, proper supervision and regulation is there, so they can handle this credit crisis.
In the question, there's a second part to the question also, which I'd like to come back to. Okay, there's that dimension. That's one dimension about creditworthiness. But let's look at also the second question which Lee has posed. How do you also deal with the cross-border risk that's going on here? Because with digital financing, you will see a lot of cross-border transactions also happening. Again, now it's not just within the country, it's also between countries that you see these problems occurring. So if you talk about, Mr. Lee has provided a very good question. The regulation tends to be within the country, but these are transnational type transactions. How do we deal with this? I like all these questions because, Dr. Banna, the questions are showing us, if I may, the reality of banking.
That's true, yeah.
They're showing us the reality of using banking services. They're showing us the problems with using banking services. People are getting worried about using banking services, especially with greater digitalization. But here you are coming and telling us this is the way forward, it'll solve a lot of social problems. But the reality is, as you can see from the questions, is that they're suggesting that may be true, but the history seems to suggest something else. So history suggests a lot of problems, in fact. Scamming, corruption, cross-border money laundering. So, Dr. Banna, how do you respond to these questions from the audience? These are all probing questions.
Yeah, the cross-border risk, though it's quite difficult, but if the regional cooperation can be done among the countries, like
yes,
the anti-attacking cyber attacking group, they can introduce among the region, or even if possible, though it's quite tough, there should be some central, the central anti-cyber attacking department. They can handle all these things. They will have access, and there's some, and that's why in that case we can use the machine learning things and also the artificial intelligence work, so they can trace out this kind of scamming, and also what are the the risk is going on among this cross border, and also among the world actually, this cyber attacking, and also the terrorism financing and all those things. So there should be some independent body especially to handle this cyber attack and all those things.
So again, we come back to, if we want to promote digital financialization, for this process to work effectively, new institutions, oversight institutions have to come into play. We need to create oversight institutions to monitor this very carefully.
Yeah.
Okay.
So monitoring and supervision and regulation is very important.
Okay. Since we are waiting for questions to come in, I'd like to go back to your paper. Can we go back to, I would like to bring up the paper and discuss. Can we go to page 10, please, of the paper? Now, if you look at page 10, page 10.
10.
Can we go to page 10, please?
10 is the outline.
Okay. Yeah, go back. Yes, go up, please. Come down. Come down. Next one. Okay. Can you pull up the figures on the, can you pull up the figure one more? Tap it, please.
Yeah.
Yes, here we are. We come back to this. Now, this is very interesting.
Yeah.
Because this is what we really want to look at. Here you have a good regional perspective. You have China, very well advanced, Pakistan, Nigeria, not so advanced, with Bangladesh, East Asia, South Asia. You have Latin America also, which is very interesting. Compare Brazil and Mexico. There are variations here. So if you look at variations within regions, look at Pakistan and Bangladesh. Enormous variations. Two underdeveloped economies. Then look at Indonesia. Indonesia is looking quite good, Now, I'm trying to make sense of this again. And I'm also looking at Vietnam. Vietnam is not bad compared to the number of citizens that we have. And yet Philippines, privately owned, very poor. And I'm trying to make performing very bad. This is a very important comparison for digital finance. And this is an important figure because most of these countries have a high volume of poor people.
True.
The rate of poverty in these countries are very high. So how do we make sense of these figures? I get the impression that if you want to solve this problem, what the government should encourage is more regional banks, small banks. Because you mentioned the point about microcrediting, giving out support to rural industries. They tend to be micro enterprises. It's a different kind of financing than what the bigger banks can offer. So this brings me back to the issue of the ownership structure of these banks. What are the best type of banks for promoting these kind of things? Should we look at a different model, small banks, regional type banks, possibly also supported by the government too, to promote it? Otherwise, we are not going to solve this problem that we are seeing here. So how do you interpret all this, these numbers that you have given us? As you can see here, the total number of adults with no bank account, 1.7 billion.
True. All over
and the banks that we are talking about, the foreign banks and the privately owned banks, I don't think, even though they think that this is a big market, 1.7 billion people, will not be probably too interested, because they will not provide them with the profits, the returns on their investments, which of the volume they would like to see. So we may have to even change the model if we want this system to work.
True, yeah, like you said, we maybe some regional and small banks like SME types banks, maybe so more.
Does your data indicate all this? That the more regional?
This one is basically from the global
phenomenon.
Yeah, so the World Bank data. So I just got this data from them. So just show the how many adders in the world is without a bank. It's basically 2017 data. It's a country-wise comparison. And so yeah, we can see is like you said, the small types bank and also the government own bank can also help if they really want, because you know that the government can directly intervene them. So they will look at the people's the development. So through the government, that kind of bank can help to minimize this number.
So it comes back again to the type of banks that we are talking about. Yeah. And again, if you look at this overview, why we should care, if you look at what you say here, it's mainly still cash-based, Thailand, Indonesia, Philippines.
True.
It's still cash-based.
Still cash.
That's the thing, you know.
That's
and with people, it's still cash-based. We can talk about digital financing and all that, but when it comes down to the crunch, especially in rural areas, microcrediting and all this kind of enterprises that they are in, which are really micro enterprises, they still work on a cash-based basis.
True.
So that's the reality. Will this provide the possibility of making a reform or change? Can this work with people who prefer cash-based type enterprises?
Yeah, if they are they're provided by the proper literacy, the digital literacy, and how to use this and what are the benefits of using these, and then I think that there is a possibility to change their mind.
Okay, so it's how we educate the people and get them on board. But I'd like to come back to China. China is a monumental success, if you think. Cashless society in many ways. They don't use cash anymore. It may be, of course, a more urban phenomenon, but this is where the comparison becomes interesting. How did China achieve that? China went from being very poor to high middle income country quite fast. Now look at the level of technology. The number of people who use cash now is diminishing significantly.
True.
So that's where the comparison comes in. You know, Thailand and Indonesia were far ahead of China. They industrialized much earlier than China. But look at China in terms of being a cashless society as opposed to Thailand and Indonesia. Again, what are the lessons we can learn from countries like China, which went cashless, using these digital financing methods, as opposed to why these countries have fallen behind? Any suggestions on this?
I think there's an issue with the year. It's a 2017 data. So if we have the latest data, then we can see the trend, how they're changing now. Because the digital financing is quite a recent phenomenon. Like she started recently, and people are more using these types of services, especially the digital service, after 2007 and onward, especially 2016 and onward, basically when the the industrial IR4 has started. We can see it's 2016 and onward. So it's the trend is increasing towards the digital finance. So I think if we look at the present data, then the scenario will be different.
Yeah, so the study has to be updated.
Yeah.
Okay, are there any more final questions from the audience? So since we have no more questions from the audience, let me give you the opportunity to make some closing remarks, Dr. Banna. From the feedback that you have obtained, from the questions that you've been asked to deal with, would you have any closing remarks for us?
The one thing I can say that if we want to implement the digital financial inclusion, we have to focus more on the proper supervision, regulation things, regulatory issues.
The regulation comes up, yes. The question of regulation came up. The question of institutions also came up.
Of course, yeah. The types of
different institutions.
Different institution, and also the ownership structure is very important.
We do need to look at institutions also to get facilities to the poor.
True.
And that seems to suggest now the role of the government becomes even more important.
Yeah, of course.
This is not a private sector thing. The government also needs to provide the proper facilities and institutional framework for this to work. And that's what I think we have seen. Possibly I may be mistaken, but we have seen in terms of where China got it right in getting this done. A lot of government intervention to get this technology upgrading to allow for this to happen. So on that note, let me bring this seminar to an end. I would like to thank you, Dr. Banna. This has been a very interesting topic. I do think that digital financial inclusion is important, but the lessons that we have learned from your study, and I must admit it's only based on 4 ASEAN countries, I do admit that, but while the idea is good, there are serious structural problems that need to be overcome. That's one. Second, the issue of access to the poor also seems to be problematic using this digital financial inclusion that seems to be coming through. Whether they are ready for it also seems to be a problem. Whether the infrastructure is available for it also is problematic. So it comes across that these ASEAN countries do have a lot of structural problems that they have to overcome if the digital financial inclusion idea is to be made truly viable. But on that note, it's a very important study as to where we are now and where we can move forward to. And it also raises questions as we move forward, what are the new institutions we have to create? I'd like to thank you for putting all this on the table for us to think about. There's a lot of ideas here for future research.
True.
We also have to expand the scope of the research, the number of countries, and I do hope you will expand your scope of research to include a lot more countries. And I hope you'll go beyond ASEAN and compare us with, say, Latin America or Africa, as you're suggesting in your first slide. That'll be very interesting to see how different emerging economies in different continents are dealing with this problem. So before I close, let me say this, we'll have another seminar series under the Ungku Aziz Center, and this will be on the 3rd of December. And the topic is very, very interesting. It's on income and religiosity, the dual escape hypothesis. This is a topic which I'm looking forward to, income and religion, very, very interesting. And it will be presented by Associate Professor Dr. Makmul Tumin of the Faculty of Economics. And the moderator will be Associate Professor Dr. Asma Abdul Rahman from the Academy of Islamic Studies at the University of Malaya. So please do tune in for that, for this particular seminar series 2, which is also based on research undertaken by Dr. Makmul. And I think you will find yourself pleasantly surprised with the findings by Dr. Makmul. So please do tune in. And on that note, I'd like to bring this to a close. I'd like to thank the administrative team of the Ungku Aziz Center for putting this together. They've put in a lot of hard work to get this done. So I appreciate their effort. Dr. Banna, again, let me close by thanking you for the study, and I wish you all the best with your future studies on this. This is an important topic. Please continue to take this forward. Thank you very much for future forums. Thank you.